What if the world's most important commodity suddenly stopped using the world's most powerful currency? Oil is not just energy, it is the foundation of global trade, and the currency used to buy oil matters just as much as the oil itself. For decades, most oil transactions have been priced and settled in US dollars. This is what's known as the Petrodollar system. It connects energy markets to global finance. It links oil demand directly to demand for dollars. And it gives the United States a unique economic advantage. But what happens if that system starts to change? What happens if oil stops trading in dollars? To understand that, you have to start with how the system works today. Back in the 1970s, after the Bretton Woods system collapsed, the United States made key agreements with major oil-producing countries. Oil would be priced in dollars, and in return, those countries would reinvest their surplus revenues back into dollar-based assets. That created a powerful cycle. Countries needed oil. To buy oil, they needed dollars. So they held dollar reserves, and that increased global demand for the dollar, which strengthened the financial system. Now look at the benefits. First, constant demand for dollars. Every country importing oil needs them. Second, lower borrowing costs. Because demand is so high, the US can borrow more cheaply. Investors trust dollar assets. They buy US bonds. Yields stay relatively low. Third, global influence. The dollar sits at the center of trade. Financial systems around the world connect to it. And that gives the United States real leverage, especially when it comes to sanctions. Now imagine a shift. Oil starts trading in other currencies. Maybe euros, maybe yuan, maybe a mix. What changes first? Demand for dollars. If countries don't need dollars to buy oil, they hold fewer of them. Central banks diversify, and one of the biggest pillars of dollar dominance starts to weaken. From there, the effects spread. Exchange rates shift. A weaker dollar makes imports more expensive in the United States. That pushes inflation higher. Then interest rates. If global demand for dollar assets falls, the US has to offer higher returns to attract investors. That means higher borrowing costs across the board. Government debt, mortgages, business loans, consumer credit. It ripples through the entire economy. Trade shifts too. A weaker dollar can help US exports, but imports become more expensive. So the net effect depends on how trade balances adjust. And then there's energy pricing itself. If oil is traded in multiple currencies, exchange rates start influencing prices more directly. That adds volatility. It makes planning harder for businesses and governments. But this kind of shift wouldn't happen overnight. It would be gradual. Countries would start with bilateral deals, paying in local currencies, building new systems over time, and the motivation is already there. Some countries want less dependence on the dollar, others want to avoid exposure to US sanctions, and rising powers want their currencies to play a bigger global role. But there's a challenge. The dollar isn't dominant just by habit. It's backed by deep liquid markets, strong institutions, global trust. Any alternative has to match that. And that's not easy. So, what's more likely isn't a sudden replacement, but a gradual shift toward a multipolar system, where oil is traded in multiple currencies, and the dollar shares its role instead of owning it. If that happens, the impact is big. Less dollar dominance means US financial influence. Sanctions lose some power. Global finance becomes more fragmented, more complex, more volatile. Central banks diversify reserves, markets adjust, and new financial centers begin to rise. But does the dollar collapse? No. It's still backed by the size of the US economy and its financial system. But its dominance could fade, and that changes the balance of power. For everyday people, the effects show up in simpler ways. Higher import prices, more volatile fuel costs, and potentially higher inflation. Globally, exchange rates play a bigger role in energy costs, and uncertainty increases. The biggest risk isn't the shift itself, it's instability during the transition. Markets don't like uncertainty. Sudden changes create shocks. Gradual change is easier to absorb, But there's opportunity too. Countries gain influence, currencies rise, new alliances form, and the global system evolves, because in the end, the petrodollar system isn't just about oil, it's about trust. Trust in currency, trust in institutions, trust in stability, and any system that replaces it has to build that same trust. Without it, change stays limited. So what happens if oil stops trading in dollars? It doesn't happen all at once. It unfolds, step by step. Demand shifts, markets adjust, power rebalances, and the global economy slowly transforms. Not into a world without the dollar, but into one where it has to share the stage. If you want clear, deep insights into global finance, economics, and power systems, subscribe to The Financial Story. We break down complex topics into simple ideas so you can understand what's shaping the world. Now return to the main question. What happens if oil stops trading in dollars? The answer is not a single event. It is a process. Demand for dollars declines, currency markets adjust, interest rates shift, global power balances evolve, financial systems adapt. The change spreads slowly, but its impact is wide. Oil and the dollar have been linked for decades. This link shaped the modern global economy. If that link weakens, the system changes. Not overnight, but step by step. The future may not be a world without the dollar, but a world where the dollar shares its power, and that shift could redefine global economics for decades to come.